All right. Well, good afternoon, everyone. I'm Michael Campbell. I am the founder and I guess you could say I'm the chairman of the board of the Street Smarts. This is our third installment today, and I'm just really excited about how this is really impacting our constituents, which are you. So a couple of housekeeping things. Um, I would like, if you haven't already, if you can please go to our LinkedIn page and become a follower. We are trying to get to 1,000 subscribers or followers so that we can have a LinkedIn live page for that. I'd also would like to remind you that we are selling some swag on the Street Smarts website. We'll be having a lot more of that coming up. And then later on in the comment section, I will put the link to the application for 2021's Street Smarts application. And we want everybody that wants to be involved with us, even if you're not getting an internship, you just want to hang out with us or whatever, we would like for you to be a part of the family. So before I turn it over to Emily, I do want to thank our sponsors because we couldn't have done this without them. So I'd like to thank Pincera Securities, Kingsford Capital, Beneficial State Bank, Central Valley Fund Capital, which is in Davis, and we'll be having a speaker from there this coming Thursday. Bivium Capital Management, Westpac Wealth Managers, Jermaine Carter is the sponsor there. And we have got IEQ Capital, and I'm gonna let Emily introduce Cherie, but Cherie's here representing them. So I hope you all are ready for a really good presentation, and that we'll all stay connected. And I'm going to be off screen, but if I need to come back, I will, but I don't think I am. So ladies and gentlemen, I would like to introduce you to Emily Sham. She is I think she said she's the VP of marketing, but I'm going to let her tell you what she does. She's the one that's been making those flyers that come out before each one of the presentations. So not only is she professional looking today, as always, but she's also very, very talented, and I'm very happy to have her. And also Leon, who was our MC last week. And we have on here Brahim, who's going to be introducing Ben Consoli on Thursday. So Emily, take it away.
All right, thank you. So my name is Emily Sham, and I am the marketing director for TSS. I've created some of the marketing materials. You may recognize some of my work for the flyers this week. And I also manage our social media accounts. That is some of the things that I do here. About me personally, I go to Diablo Valley College. I'm a communications major, and I'm hoping to transfer to Santa Barbara or Davis next year. So to give some updates about our, just some current updates, I'd like to apologize about the quiz issues. I get that we've had some complicated issues trying to open it up for everyone. There have been a lot of issues trying to sign in. What I can provide you information with is to use Gmail accounts to sign in for the quizzes. And if your Gmail account isn't working, I really recommend Gmail accounts that are not connected to school or work, like non-school or work-related Gmail accounts. And also, sorry about the video last week, guys. I remember that we had it up a little bit late. We had a lot of Wi-Fi issues. We were recording the video last week, and our Wi-Fi went out in the county that we were in, complete outage. And I had to learn video editing in an hour and try to string together 3 videos. So there may be a small error here and there, but overall I think it works. And if you have any issues with getting that video, please let me know. Also, to let you guys know that the quiz for today's video is open now. I have the quiz code. If you open Google Classroom and you hit join class, the quiz code is, I put it in chat earlier. The quiz code is right here if you'd like to access it while we are having our demonstration. I just put it in the chat. And if you have questions, there is a raise your hands option. And if you know how to raise your hand in the chat, I don't think I have the option to do it. There is a raise hands option if you'd like to ask a question. And yeah, thank you, Ruben. You can click on that if you have a question, and you can, or if that doesn't work, you can just type your question in the chat and we'll get to you. Leon, did I forget anything, or?
Oh, it's perfect.
All right, cool. So if I can introduce our speaker, Cherie, thank you for coming on with us. If you could talk a little bit about yourself first, we'd really appreciate it.
Sure. Hi everyone. I'm Cherie Aquino. I have worked at IEQ Capital for a year since the founding of our company in 2019. I previously worked at First Republic for 4 years under Alan Zaffron and Eric Harrison, who are portfolio managers. And then prior to that, I also worked the operations of First Republic on the broker-dealer, working with mostly internal clients. I'm a graduate of San Diego State and have been in finance since I graduated in 2007, excuse me. I'm very, very excited to kind of share the presentation, and feel free to answer any questions you guys have.
Thank you. All right, I guess we can jump right into our presentation if you're ready.
Okay.
I made you the host, by the way, so you can.
Okay, so just want to confirm, can everybody see the introduction to the wealth management that is up on the screen?
No, can you share your screen with us? I don't think we can view it. Well, at least I can.
There
Okay,
you go.
I can see it now.
Okay, great. So I just wanted to provide just a quick introduction and background about not only myself and then also IEQ Capital. As I mentioned, we are a registered investment advisor firm. We're located in Foster City. We have almost 10 billion of assets and about 66 employees. And we've been around for about a year, but the founding members, founding partners have been around for over 20 years working as a team. Me personally, I've been in finance since I graduated. It was a passion of mine going through school as I found out that my family members, my friends, and people close to me really didn't have a good grasp on what it meant to have any type of wealth management, what it meant to save, what it meant to have for retirement. And so I really wanted to get into it, getting out of college, in the hopes that I would be able to offer up some more meaningful information and some details to individuals like myself and individuals and families throughout as clients. So I'll go through, I have a presentation of just information about wealth management, just general details, and then some client assessments and some profiles that we might want to go through just to give you an idea of what it's like to work at an RIA. So what is wealth management? There are a variety of things that deal with wealth management. It could be traditional wealth management planning, meaning you have clients, you make recommendations, you trade, you have investments, you have assets, you have cash, any type of debt. There's financial planning as well that is a part of wealth management, any type of charitable donations, and then things like wealth transfer or estate planning for future generations is a lot of what we deal with. One major difference between if you want to go into wealth management is what type of firm do you want to work for, or what type of firms are there. There's what we call a registered investment advisor, which is what IEQ Capital is. It's a firm that advises high net worth individuals. We have a fiduciary responsibility to our clients, meaning we always need to do what's in the best interest of our clients. That means making sure that they have suitable investments, making sure that they are under the advisement of us, whether or not that's individuals or companies. It also means that we are looked upon and we are registered with the SEC, meaning that they have, at any time they can come in and ask to see information about our company. We also, as an RIA, receive what's known as advisory fees. On an annual basis, we charge an advisory firm or an advisory fee based under assets under management. So if a client had $1 million, we would charge anywhere from 1% to on an annual basis. Then there are also brokers, and those can be known as kind of big wirehouses, such as a JP Morgan, Morgan Stanley, Charles Schwab. It's a different type of advising. They don't necessarily have a fiduciary responsibility. They just have to make sure that they have suitable recommendations for their clients, meaning they could call up their client and say a suitable investment would be buying Apple. And that would be, they would charge a commission for that, and then that's how they would be compensated. Still advising, but just based on each recommendation that is suitable for the client at their needs. They don't receive annual commissions. It's more on a one-off trading basis. So it really just depends on what type of advising you want to do and what type of space in wealth management that you want to be in. You cannot have both. So you cannot be a registered investment advisor and then also charge a commission. You get what's called an advisory fee, and brokers get commissions. So that's one big difference between the two types of firms. For us, it's all about the relationship, and that means the relationship with the client and the advisor. So some of the type of clients that we have being in near Silicon Valley and in the Bay Area are business owners, tech executives, individuals, partners, individuals at private equity firms, venture capitalists. Inherited wealth could be individuals who inherited their wealth from their parents or from another individual. So it's more of how do they manage those assets for future generations. And then also, all different types of clients anywhere along the spectrum. So how do you really get to know your client? And for us, it's, as I mentioned, it's all about the relationship. For us, it's asking questions. It's making sure that you understand and know your client so that you can best have the recommendations for how you're going to manage their portfolio. And you really aren't going to know how to do that unless you ask, what are they types of risks? What type of time horizon? Are they looking at buying a house in the short term? Are they looking at investing in a portfolio of real estate? Are they looking for, immediately they need to have 6 months worth of cash needs for paying rent, for living expenses? And maybe that they're planning a huge trip next year that they need to make sure that they have cash available. It's really important to understand your client's needs, what types of risks they have, or else you won't be able to really make a suitable recommendation. And that just means asking a fair amount of questions about them, about their family, about their goals, about their current career, and any type of time frame that we should be aware of. Financial needs come in a variety of shapes and sizes. Some of these that you'll see on the screen are, I want to buy a home. What does that look like? How much do I need to save? How to get a loan? Should I buy cash? How much do I need to put as a down payment? What bank should I use? A lot of these things that we work are, we're the financial quarterback, and we help clients guide them through these large and important stages of their life. Another one could be, we have a fair amount of clients who work in, maybe they've been an individual who's at a startup and they received some appreciated stock and all of a sudden the company went public. What does that mean? That means that maybe they were an early employee at Slack. They have a fair amount of stock now, and then all of a sudden they don't know what to do with those positions. A lot of times they come to us and we help them either diversify, take a look at the portfolio as a whole, and how to best manage or how to navigate those types of waters.
Hey, Cherie, we have a question in the chat, if we could just pause you.
Sure.
The question in the chat is asking if there's a PowerPoint slide, or are you just going to be going off of the Word document you have presented?
Oh, can you not see the PowerPoint slide?
No, I'm sorry. I thought we were following the, thank you. And thank you for the question. That really helped us.
Let's see. There you go. Does that help? Oh, sorry. Can you see the screen now?
I can see the screen. Thank you.
Okay. I'm so sorry about that. I thought I was sharing the right screen.
Oh, you're fine. You're fine. I just didn't. I was like, okay.
I'm okay.
Thank you, though,
so
whoever asked that question.
Yes, thank you.
And there is a question in the Q&A.
Oh, cool. Can you see the Q&A, Cherie, or?
No.
Yes.
Okay.
How do you gauge the amount of risk that a client finds comfortable with? I think that will be something I touch on later in the presentation, so we can go ahead and I can go ahead and discuss that as well. As I mentioned, we have a fair amount of clients who have different needs, and I think this slide will show and illustrate. Hopefully you can see the different people now, not just my Word document, but we also have different strange requests, such as even this one on here that says, I just want to live my life and party, and also I'm going on a sabbatical. These are actual real things that clients have said to us, and that have been things that clients have, interesting enough, are needs that they need to have. And a lot of those are, how do I continue to live within my budget? How much can I afford to spend on my home? What kind of needs do I have for spending needs? If I'm going to be traveling, what does that look like? And then lastly, how do I plan for, future generations? It's really important for some of our clients to be able to share their wealth, to be able to transfer as much as they can to clients and to their children, to charitable contributions, and then also if they want to give to their alumni, if they want to make sure that future generations are kind of really taken care of. That's a lot of what we do is kind of a state planning and transfer of wealth. An investment philosophy. A lot of times when you go to a firm, you'll see, kind of what type of asset allocation are they looking for? Is it going to be equity, fixed income, type of real estate, and what exactly are those? Equity, you probably understand, is it kind of refers to ownership of a company, meaning you go buy shares of Apple. These are all public companies. You can go buy shares of Slack, you can buy shares of Google, Disney. Buying equity or buying stock means you have a certain ownership in that company. Typically, it will be in the likes of shares. Another thing is fixed income, and that's usually associated with debt. It's less risky than equity. If you kind of think about it as a loan, meaning you're loaning a company money, and in return you receive any type of interest. It's going to be less risky because you're not actually an owner in the company, you're just kind of lending. And then lastly is any type of real estate would be, or opportunistic, would be typically referring to senior housing, any type of hard assets such as gold, or any type of private investments that typically would be for an investor. Difference between investment management and wealth management. I would say they probably go a bit hand in hand. Sometimes in investment management, you'll have individuals who are in investment banking, meaning they'll advise large companies, they'll advise individuals on how to go public. When you talk about wealth management, you're mostly talking about individual wealth, and you're talking about a family's wealth situation, maybe a small business owner. It's pretty much a broad statement, but investment management, when I think of investment management, it's more of investment banking and how are you going to oversee the investments for a large company, or how to work with maybe a Morgan Stanley or with a JP Morgan on how to a company to go public. An efficient frontier, and I'm sure many of you have seen this before in your college books. Kind of what does that look like? After we've had a conversation with a client, we've talked about their goals, we've talked about their wants and needs, we've talked about their risk. It's how do we go ahead and construct a portfolio that is in line with their asset allocation needs, with their time frame, and what does that kind of look like? An efficient frontier is just a set of optimal portfolios that offer the highest expected return for a defined level of risk. Meaning, if you're on 100% stock, you're expecting to have a fair amount of risk, but a fair amount of high return. If you are in 100% bonds and you're risk averse, you're a little bit afraid of the markets, maybe you'll have lower return, lower risk. So you kind of want to construct a portfolio that is in line within the efficient frontier based on a mix of stocks or risk, bonds, or fixed income, less risk. So now we can go through some pretty simple client profiles and kind of what does it look like for individuals. How do we see what kind of portfolio would be the best to construct for a certain particular client's wants and needs? And how do we go ahead and risk that? And how do we go ahead and assess that? This is Cherie. He's single, ready to mingle. He's an engineer at Google. Goals are he wants to buy a home, not sure when, maybe doesn't have any time frame or needs, but knows that that's something he wants to do. He's okay with taking risks, loves stocks, wants to grow his current wealth, doesn't have any concerns, and long-term time horizon as he doesn't really need the capital yet. This is pretty much a client that we have who really wants to be able to invest, grow his money fairly, pretty young, so he can take on a little bit more risk and has a longer time frame. So what does that kind of look like as far as how do we go ahead and invest his portfolio?
I believe we also have a question in the chat, if you could answer this. How did you personally go about building a book of business?
So I actually don't have my own book of business. I work for an advisor who has built his business over the years. He originally worked at Goldman Sachs, followed by Merrill Lynch, and then opened up his own business. Building a book of business comes with a fair amount of responsibilities. It's a lot of hard work of making introductions, asking for referrals. So building a book of business doesn't necessarily come overnight. You really have to start off either working for an advisor, such as myself. I could work for an advisor and inherit a book of business, build up relationships, and go from clients that way. Or it could be that you start off at another firm, such as like a JP Morgan or a Morgan Stanley, and they kind of have a program that's set up for advisors to go through different stages of starting off with an associate and then how they kind of work that way. So it really just depends on the firm, and it depends on the individual of really how they want to get to building that book. One of the main things that we in finance find interesting are the types of investments. So taking a look at Cherie's portfolio, what types of investments would that be for an appropriate individual who is looking for risk, is okay with a long time horizon, and what does the portfolio construct look like? One of the things you'll see a fair amount in wealth management is passive or active management. And what does that actually mean? Passive mimics the investment holdings of a particular index. So it could be the S&P 500. Fairly low cost, meaning that they believe that the markets are fairly efficient. There's nothing out there on the companies that an individual is not going to know by reading on the internet. A lot of times this will be in the form of an ETF. It could be a mutual fund. An ETF is an exchange traded fund. And most of the times, anyone can invest in these. You could open up an account, buy this type of investment, and be on your way. Active investment, active management focuses on outperforming a market or a benchmark of the S&P 500 by making small different types of recommendations or stocks. Basically, it's usually a stock portfolio where they think they know more about the broader markets, about a company, and kind of how to construct the portfolio. So maybe they think that tech is going to be overweight, so maybe they'll buy more Google or Apple or Facebook, and instead they'll have the portfolio be constructed on more tech, and maybe they're less into financials. They don't really like banks, so they won't be buying Bank of America or Wells Fargo. That would be a type of active management where they are constructing a totally different portfolio based on their bias of how a company is doing. For Cherie, he's okay with high risk, but that comes with high volatility. This is actually a portfolio that you would find with one of our clients. It would be constructed of pure equity, meaning he would be having full stock portfolio. And one of the other things I didn't really touch upon is what type of investor he would want to be. Does he want to be invested in US companies? Does he want to have international exposure? And sometimes that really depends on the advisor and their thoughts and their ideas about how a equity portfolio should be constructed. For us, we've been overweight US, meaning we believe US companies are going to be far outweigh or outperform their global counterparts, such as companies in Europe, the UK, anywhere in Japan. And this doesn't necessarily mean that, of course, Google has offices and all around the world. But this is kind of more of just us saying that we think, Apple as a whole or Facebook as a whole will kind of do better than companies in the broader world. So this would be constructed of 85% in US and 15% in international equities. As you can see, the symbols are represented are all mutual funds or exchange traded funds. For us as a company, we believe that low-cost mutual funds and ETFs are going to be and will outperform any type of active management where you have a fair amount of individual stock portfolios. It's really to each their own about their type of investment philosophy and strategy and whether or not the client is in agreement of how the management of the portfolio should be. Client profile 2 is Andrew. He's married, he has a child on the way. He's a doctor at Stanford, wants to possibly move to a larger home in the next year. He's really into college planning for his child on the way. Charitable donations is a big thing. Not necessarily a risk taker, but wants to understand the importance of a balanced portfolio. Another concern we have for a fair amount of clients is high taxes and how does it look like for future trust planning, creating a trust. What does that actually mean? What happens to my family if something happens to me and I pass away? This is all about long-term planning with the intention of holding back some cash for the short term for a home. This is a fairly reasonable client expectation and kind of what they would expect. Can you please explain how much percentage of the client's money you get as commissions, fees, and profits? Are there any laws or regulations about this? So for us, it would depend on the client's assets under management. So if you had $1 million, we might charge 1% of the annual as an annual fee for that client, $10,000. So it really just depends, and that would be charged on a quarterly basis. It could be more or less. When it comes to fees, there are rules, meaning, we don't charge commissions, we charge an annual fee. And it really needs to be in a reasonable amount. You can't say, I'm going to charge you maybe 5%. At the end of the day, if the SEC comes in, you need to be able to show what your annual fees are by an investment management agreement, and then the client has consented to paying those fees and that they're in a reasonable amount. So every single one of our clients signs what's called an IMA. It's an investment management agreement between us and the client, saying that on an annual basis, they will pay a percentage of their portfolio as a fee. So if their entire portfolio, as I mentioned, is $1 million, they'll pay 1%, and then they'll pay that to us. How is that charged? On a quarterly basis, we look at the portfolio. So at the end of each quarter, the client has $1 million. We'll take, 1% of that is on an annual basis, but they'll pay, 0.25% each quarter. So it equals 1% on an annual, and then they'll pay that to us. Other things that could be, rules and laws and things are, if a client fires you, then you go ahead and that agreement is expired, and you go ahead and reimburse any types of fees. So for us as an RIA, it depends on the assets under management, whether or not we charge on them, and then the annual fee that we've agreed upon. Each client is relatively the same, but there are some complexities that make it so that it either can be more or less. One of the other things about being an advisor is, say the market falls and the client's portfolio is now only worth $500,000. It doesn't mean that we'll be getting paid the same amount as if they had $1 million. We'll still only get charged the 1% on the $500,000 on an annual basis. So the more they make, the more we get paid, kind of thing. And our goal is to make sure we're staying kind of in a reasonable amount of risk in time frame, so that we can make sure that their portfolio is in line with what their needs are. So if a client says, hey, I'd like to buy a house in 6 to 12 months, maybe that means I don't want to be invested in the market. Maybe now it's also perfect time to start planning. I have a child on the way. What does that look like for, college savings? Then maybe it's time to maybe look at a 529 account. And what does that actually look like? What are those? And then maybe I should open up a trust. What type of trust? What type of planning? So these are the types of conversations we have with individuals who kind of have these sort of needs. A 529 account is a tax advantage savings for education, meaning it has a custodian, so an owner, could be me. I could open up a 529 account for my niece who is 6, and then I could fund it. It would grow tax deferred, meaning you don't pay taxes on the growth. And my niece could use the amount in the portfolio for any types of college needs that she has. So it could be for school, could be for books, could be for housing, cannot be for a spring break trip. It cannot be for, her going off and partying. It would be really more of just for school, for the purpose of school.
Hey, Cherie, this is Michael. I had one of these accounts for my son, and I was able to use it to pay for the SAT and the ACT tests. So I just wanted to mention that.
Yes. And you could use it for a certain amount for higher, private high schools or whatnot, there are some limitations as to what you can or cannot buy. But yes, you could use it for tests, for any things that are really associated for higher education. If they decide to go to a more, type of school that's maybe not necessarily for continued learning, but it's maybe they want to go and they want to learn more about computers or whatnot, those things as well. It's just you cannot use it for if they like to buy a house. That's kind of one of the disadvantages of a 529, is that it must be used for kind of educational purposes. I have a question. Are there any structural changes in wealth management industry because of automation? I would say definitely. Mostly, I think this question is kind of coming about automation, probably about like robo investing, if that's kind of what it's referring to. I would say yes and no. A lot of younger individuals or millennials or people who are just starting out, automation and kind of robo advising probably makes sense. It's less expensive. You still have the portfolio construct based on your risk and your time horizon. You're still able to be invested in individual stocks or ETFs. So I think it's definitely has made some wealth management changes. That said, once you start to get into a little bit of a higher wealth zip code, maybe a little bit higher net worth, you want something that's a little bit more constructive for your needs, and you have a relationship. So sometimes that doesn't necessarily translate to having a robo-advisor, but having an actual individual who can pick up the phone and you can have a conversation. A lot of what we do is being a financial therapist for a lot of our clients. It's making sure that they're comfortable, they can trust us, they can pick up the phone, they know that we'll be available for any one of their financial needs. Roles: do CPAs take part in field of wealth management? CPAs are extremely important when it comes to wealth management. I would say we are financial quarterbacks, meaning we work closely with CPAs on what does your tax situation look like? What are ways in which we can make sure we minimize your taxes? We are in California. We have a fair amount of individuals who have fairly high taxes, and so working with the CPA on constructing tax advantage ways for clients to maybe save, maybe they put more money into their retirement, maybe they open up a 529 account. So CPAs are kind of part of our wheelhouse of individuals we kind of coordinate and speak to on a regular basis, along with kind of attorneys and estate planners. Can you talk about cash balance plans and how they are fit on top of pre-existing 401k plans? How many cash balance plans can one individual have? Do you have any clients that you use these plans? Yes, we do have individuals who use cash balance plans in conjunction with their 401ks. Typically, it's individuals who are, mostly I see it with doctors and whatnot, who are able to contribute more than their typical 401k amounts. They usually need to go in conjunction with employees. Typically, you'll see they'll have a cash balance plan, but it's usually for kind of small businesses and have employees in which they can contribute to their employees' plans, but then also stuff away more for kind of retirement. For Andrew, who $1 in cash, kind of not so much taking risk, maybe wants to think about how to take advantage of, planning for his house, and also is a California resident, works at Stanford. So a lot of times what we see is individuals who, as I mentioned, are in California. They maybe don't want to pay taxes, ordinary income on the income that they receive from fixed income. So what does that really mean? When you live in California, where we pay state taxes and we pay federal taxes, you will get taxed on income or interest, dividends that you receive from your investments and what's called ordinary income. So just really depends on your tax bracket. if you invest in what's called a municipal bond or California municipal bond, such as Appleton Partners, and it's a California, meaning you're buying municipal bonds for California, they will be no taxes on federal and no taxes on state. So meaning that the income that you generate from those are tax-free. And this is kind of, for our clients in California, is something that's attractive to them. Of course, it's fixed income, so it's going to be lower yielding than, or lower return than what you'd find in an equity, but it's part of a placeholder, or it's part of an overall portfolio that is attractive, kind of on an after-tax basis when you look at this. That's kind of the fixed income portfolio. And then we would mix in, again, the public equities that we had for the previous client, Cherie. So this would be constructed of 40% in a public fixed income and 60% in public equities. This would pretty much be maybe a balanced portfolio. One question, do you have a minimum of how much the client can invest? And does each individual client have a different portfolio, or do you combine all the money from your clients to have one portfolio? That's a great question. Each firm is different depending on how much minimum of a client can invest. I would say we do have some types of minimums. Of course, there's exceptions to everything. But if you yourself wanted to go ahead and you wanted to invest by yourself, you could go invest in a Fidelity account where there's really not a minimum. For us, minimums, it really depends on kind of the future of the client, if we think they're going to be a larger relationship. But for us, we typically look at high net worth individuals with anywhere from 1 to 10 million or so. And does each individual client have a different portfolio? Yes, every single one of our clients has a different portfolio, but what that means is that they have a different combination of fixed income and public equity. So meaning not everybody is a balanced portfolio, not everybody is conservative. It's more of, what does it look like as a whole? How does it fit that client? What types of needs do they have? Maybe they don't want to be in US. Maybe they don't want to be in international. So we do construct portfolios that are going to be, each client's going to be different. Because every client has different needs, we really want to make sure that it's not a cookie cutter, that we don't just have one portfolio that fits all, because one portfolio that fits all really doesn't fit everybody. And you really need to make sure and be mindful of kind of what people's needs. And then do we combine all the money from your clients to have one portfolio? We typically look at a portfolio as a whole, meaning a client could have an individual account, maybe just me, a joint account, maybe me and my husband, and then also an IRA. So when we look at a portfolio, we look at it as a whole. Now that's really up to the advisor. That's really up to the individual, whether or not it's to put all money into one portfolio. But by and large, we look at it more as a whole, as opposed to each individual entity or account. That's a typical up to the advisor type of thing. And then as Andrew mentioned, he wants to save money for a house. Now, with somebody with a shorter time frame, maybe that means that they don't want to be fully invested in the equity markets, meaning they don't want to put all their money into stocks. What if they invest that money and then all of a sudden there's a market downturn? So we will probably invest in something that's short term, meaning they can go ahead and sell the funds at any time, less risk, so maybe it'll be fixed income, and then it'll be a portion of the portfolio that they'll need to immediately withdraw. Question, how do you typically arrive at an efficient portfolio frontier for a client, since it's translating client preferences into quantitative metrics is hard? I would say that we do try to see what is going to be the most efficient for a client. That doesn't necessarily mean we're always going to get it right. As long as we are in line with the client's risk, that they can sleep at night, that they don't feel they need to be worrying about their portfolio and if they have too much stocks. I think it's more about the construct as a whole and making sure that translates to a client's needs, and not necessarily about always the return. I think for us, it's, of course, we're wealth managers. We want to make sure that, we get the highest return for each client, but that's so unpredictable. We just want to make sure that the asset allocation is really in line with their long-term goals and strategic for them for now, and then also for, for future. This would be the proposed changes for the home. So, the other previous question was, would you have one as a whole, or would you kind of look at it separately? This might be a time where we would have not necessarily look at the portfolio as a whole, but have more of two separate types of accounts or two separate types of entities and two separate proposals. And then our last one would be Stacy. She's divorced with 3 children, so meaning she doesn't necessarily support them. She's 62, she's CEO of a venture capital firm. She has a fair amount of charitable donations, charitable needs. She is CEO of venture firm, meaning she has pretty much a fair amount of risk in her day job. Likes individual stocks from her portfolio companies, but needs maybe diversification. No time to manage her portfolio, and service is important. This is a fair amount of clients that we have where they can definitely manage their portfolio themselves, but they have very busy day-to-day jobs. Maybe they just don't have the time to do it. And service is extremely important, meaning when they send us an email, when they give us a call, it's expected that they will receive an answer fairly quickly, or that they will know that if they call us, we'll be able to kind of answer any types of questions that they have. Semi-demanding, but a lot of times very reasonable expectations for some clients who are, at the end of the day, paying a fee for our services. So what does this look like for Stacy? Donor Advised Fund is a great way for clients to have charitable donations. What that really means is, say they have a stock, they own Disney, that they were given when they were a child, so it's fairly appreciated. They would have to pay huge gains on it, so they would have to pay tax on that. And what does it mean if they have some, they'd like to donate that stock, or they'd like to donate those proceeds? A donor advised fund is a great way to do that. What they'll do is they'll take that individual stock. It could be funded with, cash or whatnot, but stock is best. And then they'll donate it to a donor advised fund that's for their individual name. They'll take that appreciated stock position, get a tax deduction in the same year, and then say that they bought the stock for $1. It's now worth $100. They donate it, the $100. That appreciation they don't have to pay tax on because they've donated. It's fairly inexpensive to manage a portfolio or a advised fund of this size. There's, low minimums, it's flexible. They give it to the DAF, and then what they do from there is they could sell the position, they could reinvest it into more diversified mutual funds or ETFs, and then they can go ahead and give to any types of charities that they like that are established 501c3. So they can't necessarily donate to all charitables. It really has to be something that's established. They cannot give a donation to a family member, but they could give it to a school, they could give it to their alumni, they can give it to Street Smarts, individuals like that who want to go ahead and donate stocks, but then want to be able to give maybe this year or next year. That's a great way to kind of establish that. Then there are foundations. A private foundation could be like the Bill and Melinda Gates Foundation, which are fairly large. They're private foundations. They're very expensive, meaning they have to have somebody who manages it. They have to have somebody who on an ongoing basis makes sure they gift. It's expensive, but definitely something that they can go ahead and establish. What type of clients does your company look to stay away from? How do you deal with clients that move from volatile to safer position and returns are not what they would expect, even though you are preparing that client for retirement? Type of clients that we would want to stay away from probably would be clients who are not really in line with our type of investment philosophy. I think a client, possibly one who really wants to make their own investment decisions and drive, we are, and we always say this, we are not great market timers. We do not know if and when the market is going to fall, when to sell, when to buy. We're more of long-term investors. And so if a client that wants to move from volatile to safer positions, usually that's a conversation. And a lot of times it's, you know, if this portfolio is for the long term, then buying and selling doesn't necessarily mean that you're gonna, at the end of the day, have higher returns. It just means that you're creating a fair amount of ins and outs. There could be some types of costs associated with that. And there's no knowing whether or not you timed it correctly. If the returns are not what they would expect, it's typically because it's maybe hasn't been enough long enough time frame. Maybe they thought that they were going to be invested in something that's a little bit more risky and that they were going to have higher returns. For us, setting client expectations is probably the most important thing. It's a construct of the portfolio. What expectations could they probably get a return? Clients that we try to also avoid are ones that just have really unreasonable expectations. They want really high returns but no risk. Well, that doesn't exist. They want no risk. They want to have the highest returns, but what does that look like in building a portfolio? Those are just managing expectations that really are difficult to do and maybe not be the best fit for us as a whole. One of the things that we also get to is for clients is that they have cash. How do they invest in cash if all of a sudden we say they should buy stocks today and all of a sudden tomorrow we buy them? The next day after that, stocks plummet. All of a sudden it's March again of this year and they've lost 30%. They would probably not be happy. They would probably say, Cherie, you're fired. What we do is we try to kind of mitigate that by doing what's called dollar cost average, meaning we'll buy a portion of the portfolio, either time-based or based on, you know, kind of how the markets are doing. Typically it's buy every month for the next 4 months and kind of what does that look like? And then that'll kind of smooth out the volatility, that'll smooth out their average cost. How many times do you need to meet with your clients before they invest their money in your company? And how often do you interacting with your clients? We meet with, depending on the clients before they invest, a lot of times it's a referral, meaning an existing client has referred us to them and they'd like to continue to work with us. So maybe they only need to meet us one time, or maybe they need to meet us multiple times in person to build up that relationship. They have a huge family portfolio, so maybe that means not initially off the bat they like what we've come back with. It takes 1 or 2 go-arounds of a portfolio construction for a client to say, okay, I understand that. We're fairly transparent with how the portfolio is going to be built, what types of investments we want our clients to really understand, so that at the end of the day, they weren't blindsided if all of a sudden they don't know what their portfolio looks like. We meet with them at least on a quarterly basis, meaning calls or Zoom meetings or in person when we were in a pandemic. So it really, sometimes I have one client who calls me almost every single day just to make sure everything's okay in her portfolio. And those are really just the types of relationships that we build up with every single one of our clients. It's really different for each one. And then lastly, for Stacy, we have clients who already have existing portfolios, and what does it look like to construct them from positions they already have? So we don't really necessarily want to sell a position if the client wants us to hold it. Maybe they really like CrowdStrike, or they like Shopify, or they don't like it. When it comes to clients, and this is a lot of times, they already have an advisor. We've looked at the portfolio. We've said, hey, we probably wouldn't buy that, or hey, we think we can do this better. Then we'll go ahead and make recommendations, go back and forth with clients of how we should reallocate the portfolio, invest the cash, And then what does that look like tax-wise? How do we go ahead and navigate those waters of individual stocks and going into, you know, a more diversified portfolio? So a lot of what we do is there's a lot of back and forth. There's a lot of talking about, you know, what stocks do we want to continue to hold? What type of mutual funds? What is your actual investment philosophy? And are there any positions that you like long-term? Some people are really wed to individual stocks that they received as gifts, and maybe that they want to continue to hold those. So I'm going to build a portfolio around those, and what does it look like for the rest of the investments that we're going to offer to them.
Hey, Cherie, do you want 10 more minutes or, oh, you're in the Q&A section?
Yes.
All right, perfect. We'll just wrap this up around like 3:40 or whenever you finish the Q&As.
Okay. So one question I have is, could you talk a little bit more portfolio rebalancing? Does it happen on a schedule or based on client requests? So portfolio rebalancing typically will happen if, say, the market has skewed heavily and the client's portfolio is now supposed to be 60-40, and then all of a sudden now it's 65-35. We don't have a schedule where we're constantly having to look at the portfolios if clients need to raise cash, if they need, they receive new investments or new cash from other existing investments. So for us, it really depends. For endowments or institutions or nonprofits, we pretty much will look at it on a quarterly basis and then need to rebalance the portfolio from there. Clients typically don't request it, or it could be that they're all of a sudden getting nervous and they want to look at the asset allocation. What kind of certifications do you need to begin your career? I would say starting off, you know, going and, you know, taking finance classes when you're in school is great. Actual certifications depends on what type of firm you're going to be working at. If you're going to be working at a broker dealer, as I mentioned earlier, you'll probably want to get your Series 7, your Series 63 or 66, and those are registered so that you could be an advisor. Fairly long test that you can study for. For us as an RIA, we have a Series 65. There's also, you can be a certified financial planner. But if you really want to begin your career and you're kind of going off college, sometimes it's worth starting off at a firm to see what they offer. Some of these tests are fairly expensive, so it's great if the company will pay for them. Your CFA is a fairly extensive test. It's could take up to 3 years to get, but that's also one if you want to go into more analysis, if you want to do that type of investments, then your CFA is a great one. What made you choose wealth management over the other finance fields when you first began your career? For me, I would say it's really important about the relationship. We're a different type of firm where we value the relationship as much as we value the analytical and the analysis part of it. So for me, I like to speak with people. I think that's probably my strong point. The interactions that I have with clients, I'm an introvert at heart, and so it's very hard for me to get out there. And so I think being in wealth management has helped, you know, build those relationships with individuals at the firm and then also with clients. So it really just depends on what you're looking for in wealth management and what type of firm. It could be something that's very structured, and for us at IQ, it's more of, if you work hard, then you really will excel as long as you continue to work hard.
Well, if there are no more questions, Cherie, you have the host capabilities of ending the stream. But first off, we really want to thank you so much for coming on and speaking and teaching for us. Oh, there's one more question, but.
Can you point out some good books on wealth management? Oh, I have a slew of books. Could I email them to you guys? I have a fairly long list of books that would be very at least helpful and kind of rating to kind of get the start.
That would be great, Cherie.
Okay.
So Emily, looks like we might be done here.
Yeah.
Cherie, again, thank you so much. And I know Michael was looking on. I believe I saw him. So you guys, it has been great getting to know you all and hopefully getting to know us. And when this coronavirus goes away, we're going to come over there. and see you.
Definitely.
So thank you so much. I'm going to get off. Emily, you can finish her up.
All right, amazing. Thank you so much again for speaking. I loved your entire presentation. I do not have the capability to end the stream since you are the host and you can end this when you want, but thank you so much for coming on and speaking, and thank you everyone joining us today.
Thank you.
All right, goodbye. Oh, I think there's